Hello. In this lecture, we are going to see how leverage, capital structure, weighted average cost of capital relate to steel dynamics. So instead of me starting out with just a balance sheet and getting right into Excel, I thought I would I wanted to start out with something that would be a little more colorful, and I looked at SDI and I said, oh, what's going on with careers and internships? And as you can see on this page, there's a lot of internships available for the firm. I think if you do look, you're going to find a lot of opportunities for internships, and I encourage you to continually do that. So now let's just go over and take a look at the balance sheet. And when we look at the balance sheet, we have it right here. And what we're trying to do is we're trying to assess a couple of things when you look at this. One is, what is the financial strength of the company? So if they had a downturn in earnings, what would happen? Do they have the capital necessary to expand and grow? How are they using their leverage? So once again, we're looking at the balance sheet here. And again, we see we're trying to assess the strength. And what we see, if we look, if you remember from the previous one, we had $3.5 billion in current assets and only $868 million in short-term liabilities. So what we can see is that they have a pretty strong working capital cycle. And when we look at their debt, we can see it's $2,353,000. And their equity is pretty strong at $3,195,000. So when we look at this, we're always concerned about what this equity is. Now we're going to just forget about this non-controlling interest. This is for an advanced class. Just look at the total equity is $3 billion. It's increased from $2,007,000,000 to $3,195,000. So we're trying to evaluate the financial strength, long-term straight to capitalization of the firm. And as if we could see here, this would tell us that before any of the creditors would be harmed, they'd have to have a lot of losses. So from a strength perspective, it's there simply on the visualization of it. So let's now go over to the Excel worksheet, which I have right here. And remember what I did in the first application project, I put all of the information into my Excel document. This way I know I have all the 10K data that I extracted, and what I'm doing is I'm drawing it out of my database, if you will. So the first thing I did is I labeled my headers going across. And again, notice I went from oldest to newest. And again, for those taking financial statement analysis, we're going to do it this way so that we can compute 18, 19, 20, and forecast going forward. So the first thing I did is I brought in the long-term debt. And again, that came back from 10K data, long-term debt, which is right here. So what I did is I just built it so that it brings it right over. And then shareholders' equity. So this is really, over time, what we can see is a couple of things. One, we have seen long-term debt has grown, but shareholders' equity has also grown. So what we look at is debt to equity, and then we look at total debt to total capital, total equity to total capital. So we can see that 58% of the firm is funded by equity. So it's not a highly leveraged firm. Highly leveraged might be if this number right here, so say this was 90% here, and this is 10%, what we would see in this case, this would be in the case, that'd be a highly leveraged firm. They're not very leveraged. So the question is, could they better leverage? But at this point, they're well leveraged. Okay, so what we're going to do is, I'm just going to take that out. Hopefully you got that. There we go. I look at the ratio of debt to assets, and what I see that of their total assets, 34%, 0.34, are funded by debt. So that's telling us essentially that more is funded by equity. We look at the leverage ratio, and they're levered 2 to 1. Okay, which isn't bad at all. Fixed assets to equity, we can see that's gone up and down, but again, where do these numbers come from? All these numbers come from either above or they come directly from our 10K database. Why is it important to look at tangible net worth? Well, tangible net worth is the equity of the company, which we bring it down, and then there is intangibles. So let's go back over to the balance sheet. And what we see is two things here: intangible assets and goodwill. Both of these combined are intangibles. Intangibles are assets that you cannot physically touch or represent. So they may have acquired a brand name, they may have acquired a process, some asset that exists that has value, and goodwill. So we take the two of them together, gives us our intangible assets. So if we go back over and look, intangibles, you can see where it came from. It came from the database here. And we know what the equity, because we brought it down, is $2.5 million. Now, let's take a look at what intangibles and goodwill are. Always in the notes to the financial statement, we can work our way down to find out what these are. So I'm just scrolling down, and see there we have a discussion. Okay, so when we dig down, we can find out what these intangible assets are. So these are customer and scrap generator relationship. These are ones that they have purchased through acquisitions. So what we see is when you get them, you assess how long do you think they are going to last, and you amortize them over their life. So these are assets that have been acquired. So they've acquired relationships, which they placed a value on, and trade names, which they purchased. Okay, so what they've done is they then amortize that over its useful life. So what it says, it uses an accelerated methodology. Trade names are amortized using straight line methodology, and that they amortize 29.2. So what you can see is there's 256,909 here, and this is what they're going to amortize over the next few years. So the first thing is when you acquire it, you determine in how long is the useful life, just like a piece of equipment. So when they were buying companies, they paid more than the assets, the physical assets, the cash, the receivables, inventory, property, plant, and equipment. They paid a premium, but they identified them as relationships and trade names. Now, what they will do as they're moving forward here, and you can read this, is that what they do is they look at them and say, is there any impairment of value? Are they worth less? We then come down to goodwill, and goodwill is an amount that you pay for a company in excess of all of its physical assets, cash, accounts receivable, inventory, property, plant, and equipment, less the liabilities that were assumed, less the intangibles, and this was left over. This is just the stuff that makes that company good. And as you can see, that they had $386 million at the end of 2017 that are intangibles. These aren't something you can touch. So when you can, they have impairment of value, and essentially they look at them following certain accounting standards, and that gives us the intangible. Now, these are things that when we go back to here, this becomes an important thing to look at, because if you had the point that there's still, when we take the equity less the intangibles and goodwill, there's still a lot of money left over. So when we look at companies, we want to take a look and see, how much goodwill do they have? How much tangible net worth do they have? Or is it all in goodwill? A couple of cases historically that this has indicated trouble, and when you had gone back and looked at what this number was over a period of time, you would have found that it was negative all the way around. Valiant Pharmaceuticals, for example. So if they had to write off and said this was useless, there'd still be equity left. That's the important thing. So now we come down to the weighted average cost of capital. Now remember, a firm uses this to make investment decisions. If you're going to make an investment in the future, buying a company, or if you're going to make an investment in property, plant, and equipment, you have to exceed your cost of capital to be a profitable venture. If it doesn't exceed its cost of capital, why would you do it? It's not making enough money to cover the cost of the capital needed to support the project. Okay? And think about what I just said. You might want to mark it down on a piece of paper because it'll be coming up again soon. So how do we do that? First thing I do is we take long-term debt, which comes right from G15, which is all the way, it just works its way down, long-term debt. Keep going. Long-term debt, there you go. And it comes down. Then we need to bring in the interest expense. The interest expense comes from the income statement, G13. So I go over to my 10K data, income statement, and you can see there's interest expense right there. So that interest expense is what I'm bringing over. Okay, so I bring it over, and I put it in here, and I divide these two, and this is the pre-tax rate of what they're paying on their debt for the past 5 years. Now it changes because remember, new debt is put on, old debt comes off. So then what we want to look at is, since this is on an after-tax basis, we need to put in the tax effect. Okay, so where does the tax rate come from? Again, comes from the database, and I computed this right here. Is what I did is, since it wasn't there, yours may or may not be there, but what I did is I took the income tax expense, this one right here, I divided the income before income taxes by the tax expense to get a rate. So now we see we've been at 38, 40, 40, 36, 14. So now one of my big questions would be, what's going on here? Okay, so I bring that rate over, there you go, multiply that rate by the tax rate less 1, and the after cost tax of the debt comes in at this. And since the total debt to total capital is 42, which we bring down from above when you calculate it here, it's 208 after tax. 15% is the equity. Equity is 58. And the weighted cost of equity, which is the 15 times 58, is 8.64. And now take a look at, that is a simple calculation of adding this and this together. So the weighted average cost of capital in the final year is 1072, but when we look at it, the 5-year average is 1041. So that's essentially telling us that for profit, they need to make more than 10.41% on any new investments or new projects that are going on. So that's sort of the threshold, and that's used in the decision-making process. So just to summarize briefly here, what we're trying to get an understanding of is how much of the company is funded by debt and equity, to see if there's strength. Okay, that if they did if they ran into some difficulty, what could they absorb? We then go down here to weighted. We want to take a look at this tangible net worth, because that's total net worth. We take out the intangibles, assuming that it all goes against equity. That would leave us with $2.5 billion, which is still a very strong number. Weighted average cost of capital, everything is based on formulas. So what I'm suggesting is, when you move into application project 2, what you do is you essentially utilize this worksheet. Remember, you're going to have to be using your data, what's important in the company that you're using. Not all these lines will be the same on every company. So that's a little update on Steel Dynamics, and if you have any questions, please let me know.